Good afternoon, good evening, and welcome to See the Futures. I'm your host, Tom Schneider, CMT with NinjaTrader. I know you're used to seeing Jim Cagnina. We're trying something different this week. I'm really excited to have our next guest on, but before we do that, I just want to remind everybody that trading futures and options contains substantial risk, not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend using risk capital. What is risk capital? It's money you can afford to lose, doesn't keep you up at night, doesn't extend your retirement horizon. I also want to remind everybody that past performance not necessarily indicative of future results. And what we talk about today on this program contains neither trade recommendations nor financial advice, but should be taken for educational purposes only. And with that, it's really my pleasure to welcome Katie Stockton to the See the Future show. Katie Stockton, CMT. She is the founder of Fairlead Strategies. Welcome, Katie. It's great to have you on.
Thanks so much, Tom. Good to be with you.
Yeah, Katie and I go back a little bit. I think I was working at Bloomberg when we met, and Katie, you've been a CMT for a lot longer than I have. I think I got into it late in the game, but just so people know, can you explain really how you got into this business and what attracted you to technical analysis?
Yeah, so now I've been a CMT or chartered market technician for, I guess, more than 20 years. And I started with it really early in that I was exposed to technical analysis in college, and it wasn't at all my intention to go into it. But it really just, I kind of stumbled upon it in that I was a finance major. I picked up an internship with an investment advisory firm that was local to my college. And at the same time, I saw it, I had the pleasure of working for Dorsey Wright and Associates as an intern, and they exposed me to point and figure charting. And also University of Richmond, where I went to school, had coursework in technical analysis that obviously I was inspired to audit that class given my experience at Dorsey Wright. So really set on the path very early on in my career. And my first job was actually hand charting point and figures. So it was something that I don't do anymore today, as you can imagine, but really shaped my career. And I've been doing something technically oriented all throughout. And then, of course, more recently in 2018, started my own company called Fairlead Strategies. We publish technical strategy research and provide consulting services. We also have an ETF on the market.
Yeah, that's amazing. And going back to your experience with school, I would visit Richmond, and I was just amazed at how much activity there was in the technical analysis space. I think Jerry Parker is down there, one of the original turtles as well. But yeah, when you're traveling to the big financial centers and then you go to Richmond, it's like, wow, this is a really great city. What are all these technicians doing here? And it's a hotbed, really.
That's right. It was really, surprising in a way, isn't it? Especially given the fact that my advisor at University of Richmond was really very sort of fundamental in their orientation. And I'm glad to say that they're since converted and they do adhere to technical analysis, at least to some degree. And I think what it took is just having an internal advocate at Richmond for the university to pick up that coursework. And obviously I hired one of the graduates from that course, who top of his class, as a research analyst. So a big supporter of, students learning technical analysis as part of their finance curriculum, because it's really a discipline that to me is the best complementary discipline to fundamental analysis and macro research.
Right. And traditionally, when I started looking at technical analysis again about a little over 20 years ago, I didn't get to the CMT game till well into after 2009. But there was this I don't know if it's an idea, meme, whatever you want to call it, that fundamental versus technical. There was this traditional idea that fundamental and technical analysts were sitting over there in that part of the room, and the fundamentals were kind of the big analysts in the room. And I think the most successful analysts have almost combined both as part of their curriculum. I mean, it's not it's not as in opposition as it used to be.
Yeah, I would agree with that. I mean, I think the acceptance of technical analysis as a discipline over the years has certainly grown. And that's in part just given the access to information that we have, and also the accessibility of the discipline itself. You don't need to have a CFA, which of course is a very difficult process to study charts. You really are just focused on the supply and demand relationship for any given security, and that can add value across time frames. So it really has a very general appeal. And I think it appeals to people that are trading their own accounts. So it appeals to professionals who are fundamental in their orientation. So the broad appeal, the access to information, and also how technical analysis has helped us all manage risk and navigate different market environments. And that's become more widely publicized. I think that's helped as well. I think 2008 was really a great example of that, where there's so many technicians that were far less constructive on the market that year or so than some of the other analysts out there. So I think they got a sort of a good reputation in that environment to help manage risk of these big drawdowns.
And my experience is similar in that in times of volatility and in times of where the fundamental analysis breaks down, where everybody's stymied at what's happening, like 2008, the interest in technical analysis increases. And I saw that with my work, where I would get a lot more requests for technical analysis and what it does and how it works, and help me train these people during times of high volatility, of market downturn, really.
Yeah, I call that the inverse property of technical analysis. When the market goes down, demand goes up. It's definitely the case. And it is because there is volatility, of course, in the marketplace. And that's when people need more handholding, and they have more questions that need to be answered. And they want to understand why something like this could be happening when perhaps a company's fundamentals have really not changed that much. And it's these top-down influences that we spend a lot of time on, trying to get an understanding of what the risk reward profile is for the broader market, speaking of equities here, and letting that sort of trickle down into our analysis on the individual stock level. And that also goes for what we call macro technical inputs. So things like yields and crude oil prices, anything that will influence markets more broadly and really reflect the global economy. That's all of interest to us. And we can look at it in a very unbiased fashion, just based on price alone, and trying to understand what the implications of the current trends are, and whether those current trends have any indications of maturing. That taken together with macro inputs and fundamental inputs can be really powerful.
Right. And Katie, I just have to comment, because the name of your company, Fairlead, is a maritime term, right? It's and then you came out with an ETF. And of course, the symbol is TAC, which is another maritime. I didn't know you were a sailor.
Yeah, I fancy myself a sailor. I've done some sailing. When I lived in San Francisco, we race sailboats out there, and it's a great place to do it. It's always very breezy. And that was part of the inspiration for Fairlead, which is a part on a boat that helps us guide the lines so that they don't get tangled. And then also for that TAC ETF, which is the Fairlead Tactical Sector ETF, as a way to impart that we're trying to navigate the sort of choppy waters of the market, of which now we have that, in real time, somewhat unfortunately, because we all lose money in this type of environment. But the charts and technical analysis can help us minimize the drawdowns and set us on a better foot for when the market starts, sort of entering an uptrend or reasserting its bull market.
That's great. And coming from a sailing family as well, I was, put it together when you got TAC as the ETF. But it's funny, I've always talked about charts as being a way to navigate. And this is as opposed to a graph, right? So a chart, you talk about a pilot, you talk about captain of a boat. They use charts to navigate the waters, to navigate the skies. A graph is something my 7-year-old does to compare charts, boats and cars and trucks, right? So, I cringe when I hear graph. I love to hear charts, and that makes sense with what you just explained. So anyway, that's just something fun to talk about. But let's talk about something else that's fun. Let's talk about the E-mini. We've got a chart here using some analysis that are part of your regular routine, right?
That's right. So, and we spend a lot of time on this chart in particular because it has some of the indicators that we're using. We are very heavy users of indicators, and that's not the case for every technical analyst. I guess you can call us a real navigator in that sense, that we want controls, right? We want to have indicators that will give us a binary takeaway. Is it a buy signal? Is it a sell signal? Is momentum positive? Is the trend up or down? And the indicators can get us closer to that sort of binary takeaway. So what you see on this chart in particular are some moving averages. We like to track the 50-day moving average, the 200-day moving average. And you also see the cloud model, which is the shaded area of the chart. The cloud is a great way to understand where there's potential support and resistance, and also just as a reminder of the prevailing trend. When price is below, we trust it to be a downtrend, and vice versa over different timeframes, of course. And then also here we have shown the MACD indicator, or moving average convergence divergence, which can give us a sense of what the short-term momentum is on a daily chart like this.
So looking at this chart, how would you look at, and again, on our regular bookend shows, we talk about the news, we talk about earnings, we talk about what is the Fed doing. There's a lot of information that we try to, as a day trader or as a retail trader, we want to know about. But given all of that, how would you look at this and just real quickly say, what is your, and this is when I'm brought on to talk to Jim about this. I give a little bit more of a technical view than doing all the news. What are you looking for? Or if you were day trading, what are you looking for in a daily chart?
Well, there's a number of things, and I wish there was a singular answer to that, because that would be a lot simpler for all of us. But as you know, there is no holy grail in terms of indicators or tools. So I think it's really in how you combine the tools that you get the right takeaway. And of course, there is subjectivity to that in terms of what you're weighting more or less in any given environment. But a great start on the chart that you have pictured would be just looking at the slope of the 200-day moving average as being lower. And that's a reminder, a somewhat unfriendly one, that we're in a bear market cycle. Notice also it did act as longer term resistance at the August peak. So a resistance gauge, downtrending, reminds us of the prevailing trend. And then you can also see that the 50-day moving average is trending lower as well. The 50-day moving average can at times also act as resistance, or in some cases support. So we sometimes look at it as a gauge of upside potential during an oversold relief rally, which is what we have essentially underway right now. The S&P futures came into support around their summertime lows and slightly below that as well. And it was a natural place to see a little support come into play and some reaction to oversold conditions. We're not looking at the stochastic oscillator at this time, but the stochastics would be turning up from oversold territory as that MACD indicator comes up on a buy signal. And a buy signal is just a bullish crossover in the MACD. And that buy signal, well, we're not necessarily taking it for face value and rushing out and buying a lot of stocks, because we don't like taking counter trend positions. And yet it does increase the probability that these counter trend positions will actually work in the near term. And by near term, you have to consider your own time frame, of course. For the daily MACD indicator that you see with its crossover, implications in my work would be for something close to 2 to 3 weeks from that type of signal in a bear market cycle. If we were to also look at the weekly chart of the S&P futures, you'd see some incremental improvement there too. That could add a little duration to that relief rally. So for those who are nimble, I think the takeaway would be, well, there's, a high probability for a greater relief rally here. Is that something I can take advantage of, and how do I do that?
Great. And we can look at the stochastics if you want. I can add that pretty easily. We're using the NinjaTrader platform, of course. Stochastics, we have it broken down into slow and fast. But if there's anything else that you want to see, Katie, we can certainly add it. It might not be optimized. I've tried to optimize these studies already for visual. This is for broadcast visual. This is the stochastics. This is the fast stochastics. I don't know if you use fast or slow, but it's the same kind of idea that I think Katie is saying, that we're not necessarily using one indication. We're trying to get for a signal or for a decision. It's more about accumulating all of these signals or indications. Let's not use signals. And seeing, like you said, the probabilities. What are the probabilities something is going to happen based on these indications? Because, of course, we can't say 100% what's going to happen just because a signal happens.
That's right. Yeah. I mean, I think it's a matter of thinking in probabilities, and in doing so, we can manage risk, right? We can say, well, higher probability of an up move, noting there's some room to overbought territory on the stochastics. Let's say that's 80%. It almost doesn't matter, what sort of parameters you're using for the various indicators, as long as you're going back to the same ones repeatedly. I think that's where you can get the real value from it. You'll get to know that time frame, whether it's a fast stochastic or a slow stochastic. I think just being more systematic in how you're approaching it, where you're repeatedly sourcing the same data, the same tools. I think that's where real value can be derived from the technical indicators. And the more you do it, the easier it becomes, right? You'll start to recognize setups that do have a higher probability, and vice versa. But first and foremost, we really respect the price action. We want to make sure that we're not fighting against some kind of breakdown or breakout on the chart. We want to make sure that we have the trends on our side over the time frame that we're willing to trade. So it's important to always differentiate between time frames. We also always let the longer term biases inform the shorter term biases. So let's say in a downtrending market or bear market cycle, we're less inclined to act on these short-term buy signals. So that right there is a real important takeaway, because your probabilities are just inherently lower when you're taking counter trend positions. So there's ways to nuance some of the indicators, but I think just going back to the same ones, whatever they may be, can be really helpful. We like to use support and resistance levels, which are also quite subjective, to gauge upside or downside potential based on which way momentum is pointing. And for the S&P futures, there is a level right around 39.33, and the equivalent on the cash is about 39.14. It goes back to former peaks and troughs on the chart, going back to, I think it's around July. Yeah, right there where you had your cursor. That is sort of a line in the sand, if you will, a place that we could perhaps see, the S&P gravitate towards as it sees this relief rally.
And we talk about support becoming resistance, resistance becoming support. So when we do look back, we do look for these areas where you do notice that, right? It was support here back in May. And then when we push through it with this gap down, we came back, closed the gap, but we closed it. We didn't get much past it, tested it a couple times, right? So that's the idea of, could this support area right here at 3,600 turn into resistance in the future if we keep moving down, right? If this rally expires, if this rally just peters out, we turn around, this support area could become resistance in the future.
Yeah, it would make sense, right? You think about market psychology and why that happens. It's for those that rode the market lower, sat through the breakdown, kind of felt like it would always come back. Well, their sort of psychological resolve would be to say, well, when I'm break even, I'm out, right? So that's what kind of creates that potential resistance if and when we see the downside follow through, which we are expecting based on our longer term gauges. So we're hyper focused on the short term here, but in reality, we're very sort of respectful of the longer term downtrend. And unfortunately, if you were to pull up a monthly chart, using a generic contract, you'd see that the momentum, it tells a much different picture. Unfortunately, that the MACD histogram on a monthly is still very much ticking down behind the S&P 500 futures. And that's an issue. That's an overhang or a headwind.
And the one thing that we've talked about in the monthly chart is this candle right here, this current month, we've traded down to that 50 period moving average. Now, I don't know if you use 50 or 200 on the monthly. Some people tend, I think Luis Yamada, I think it is, uses a 10 period moving average on the monthly because it's a little bit tighter. But do you find that with the moving averages on the longer term charts, not intraday, longer term charts, it's easy to switch between those periods because you just keep the 50 and the 200 in play? Or do you use different, if you can explain that?
Yeah, I would tend to mix it up a little bit, like Louise does, and in the short term charts, I'll use the 50-day and the 200-day, in part because I think a lot of other people are using that, and I want to see what they're seeing, in the event that perhaps it becomes somewhat self fulfilling as an important level on the chart. And when I look at the weekly bar chart, I actually recalibrate them so that it's the 10-week and the 40-week, because that's an approximation of the 50-day and the 200-day moving averages. It's not precise, but it's fairly well aligned with it, and you can get a visual sense of where that's happening. And on the monthly, I'm not as big a user of the moving averages, but the 12-month moving average, I kind of like to watch the slope of that moving average just as sort of a point of reference in terms of the prevailing trend over the past year or so. And it's all subjective, but it's just to give you a visual gauge, and that's what the cloud model can do as well. You can see on the weekly chart that the cloud is very much a resistance level, whereas on the monthly chart, the cloud is actually a support level. And what it would suggest is that the bear market is actually cyclical, not secular. And so we hope that's the case, of course. Things can always change, but it does frame it from a very sort of ultra long-term perspective. And it would suggest that we do want to ultimately look for a major low to be established on the back of this cycle.
And that's really interesting. I think you bring up a great point, is when you do change these periods, those indications may change, right? We have different data points, even though we can look at these daily, weekly, monthly charts and say, wow, uptrend up until about a year ago, downtrend now. It's obvious to see with the eyes, but the indications, that's why they're beautiful, is because they adapt for that data and they give us indications on different time periods where, okay, we might be okay in the long term. Let's hang tight, right? The market is made to go up, right? It's not, so at least the stock index, futures, stock market it's the nature to go up, right? But where are we in that cycle, I think is what's really interesting. And thanks for that insight into that.
Yeah, of course. I agree with you, Tom. I think it's all about framing it from a long-term perspective and knowing what that bias is, and that will help us understand what a potential duration is for this kind of bear market cycle. It will help us understand that we want to be on the lookout for signs of that major low. And unfortunately, there too, it's not simple, right? There's a collection of factors that we'll be looking for, but at least that monthly cloud can help frame that kind of in our mindset, where we're out there looking for the downtrend to ultimately mature, and probably within months, not hopefully years. And that'll put us in a good position to take advantage of it on the way out.
Awesome, thanks for that. So Katie, you mentioned crude. Let's just switch over to crude, and with that, I just want to kind of set the framework. Is with all of the things happening globally now, especially more than ever, you've got a lot of confluence here. You've got what's happening in the Eastern Europe. You've got what's happening in China. You've got what's happening here with the strategic reserves being drained. All of these things happening at once, and it's easy to get lost in the news. It's easy to see, okay, 25 minutes ago, the EIA came out with their petroleum report, right? And, there's no news, unknown news. This is why I like technical analysis, is because you can clear your mind from all of that and say, what is the chart telling me? Because this is really what the information is. This is what market participants are telling us about what they think the market is doing. If we were to look at this chart, it looks a lot different from the E-mini. Particularly the MACD crossing is troubling for me.
It is. I mean, I think the first takeaway here is, of course, that the downtrend is very much in force over the last several months. And you can see that especially in the cloud, which has acted as resistance a couple of times. And so that's the intermediate term bias. So we know that if we're taking a position in crude oil, it is a counter trend position over that time frame. Within this context, there is a loss of downside momentum. So while we've seen the short-term MACD roll over, there's actually been some incremental improvement in the weekly MACD. So it shows that the downtrend, that while it still has, or it still is in force, that it is losing some downside momentum. And then, of course, you can see that there is some potential support not too far from the recent low. And you can see that on that cloud model right there. So it does suggest that we have the potential for a greater relief rally at a very minimum. And then we can use the cloud on the daily to understand if and when crude oil has some kind of reversal, right? And that's something that would be actionable, perhaps not just short term, but more intermediate term, something to take advantage of. We are of the belief that from a very long-term perspective, crude oil perhaps has entered more of a trading range environment. But what trading range is, of course, it's developed through a series of swings, right? And intermediate term swings in this case, between sort of the two important levels being resistance and support. So we're looking for more of a longer term range, but within that range, we're using these shorter term gauges to try to time the swings essentially within that context. And, we're not it's ignoring the news. It does matter to us in the way we're thinking about the world, but we're more inclined to use the chart and to use the biases that we can get from the indicators as our action items, because the price reflects all known information at this time. And, we want to stay on the right side of what the supply and demand is for the commodity. So that this is where these indicators can be really great as not just visual gauges, but just to kind of keep us honest as to what is really happening when people react to all of this sort of conflicting news around crude oil. We like to watch crude oil. We cover it weekly in our weekly report. And we like to watch it as, some people are taking it, sort of taking the information and using it as a takeaway for the consumer. Other people would be taking the information and applying it to their thoughts on energy stocks in the energy sector, which of course has been a real source of outperformance this year in a week tape and even the year before. And so they're looking at it for cues because they have a correlation, as you could imagine. So it can be used multiple ways, sort of for a macro takeaway, for actionable trades, or for perhaps a relative strength input. So there's a lot of value to be derived from these kind of charts.
Right. And I think, if you really think about it, crude really affects everything we do in terms of products that we use that comes from crude. The fuel that delivers us our products, when we hear about supply chain breaking down, crude is key to this. Crude is the glue that holds it all together. So what happens in crude affects, I think, everything more than we'll hear about, certainly in the news.
Yeah, for sure. It makes sense to have it on our radar. We also have gold always on our radar. We're looking at gold for more of an indication of sort of risk on, risk off at times, but also, just to look at it, the trend, and to see if there's any opportunity there to find something that's not as correlated to the equity market. We're always looking for things that can give us an edge, and anything that's less correlated to equities has the potential to do that, especially in a bear market cycle. You can see that like crude oil, though, gold has also been in an intermediate term downtrend. Despite that downtrend, it's actually managed to outperform the S&P 500, and not by a small degree. And that, of course, is likely because of its more defensive or perceived to be defensive properties. But you can see here that the 50-day moving average really in action as a resistance level. Still within this context, while short-term momentum is clearly weak, there is some longer-term support coming in line, for the week or the monthly cloud. And so we'd be watching for a potential loss of downside momentum as this long-term support level comes in line for gold. So always on our radar, something that can give us potential sort of differentiation in our portfolios. And we always are looking for that in this kind of environment. There's really not many long-term uptrends to be found at this time.
Awesome. Thanks, Katie. The half hour goes way too fast. I feel like we just scratched the surface, but I think, you just so much information there. Where can people find you to continue the conversation if they want to reach out to you?
Yeah, thank you. By all means, we have a website, fairleadstrategies.com. I'm somewhat active on Twitter, so that's at Stockton Katie. And we do publish research on a daily basis. So we offer trials for our research. And the TAC ETF also has its own website, fairleadfunds.com. And so it's not easy to hide these days. You can find us online. And by all means, I encourage folks to reach out to us.
And Katie, you're hiding the fact that you're on TV all the time. I love that. CNBC,
Yeah.
MSNBC. Are you on Bloomberg? Do you do Bloomberg TV as much?
Yeah, I've done some Bloomberg recently with the volatility of late, right? There's some demand for technical analysis on the networks, and I think it goes back to that inverse property of technical analysis. When people are worried about things, they're more inclined to gravitate towards the charts, which are somewhat unemotional.
Right. No, awesome. Katie, thanks so much for coming on. And good luck with everything.
Thanks so much, Tom. Good to see you.
Good to see you. And thanks for everybody for coming, seeing the show. Hope you enjoyed it. And Jim will be back this afternoon on Bars Closing. Until then, have a great trading day.